All three major averages opening today's trading day well below the flat line. You've got the Dow off now just around 500 points, so adding to some of those losses that we initially saw here at the open. The Nasdaq, the worst performer of the three major averages, you're looking at losses there of nearly 2.5%. Jobs growth slowing much more than expected for the month of July. And this is just the latest data print, adding to the slew of soft economic data that we have gotten in recent weeks. So here to discuss what this ultimately means for your investments in your portfolio, we want to bring in Michelle Schneider, marketgauge.com's chief strategist. Michelle, it's great to have you here. So let's talk about how exactly the market is interpreting this, because we certainly have seen a shift this week just in terms of sentiment and where investors stand when it comes to that negative econ data prints. So what do you think this move, this leg, this pretty significant leg lower here tells us about how investors are looking at these concerning economic data prints that we are starting to get now a bit more frequently?
Well, first thing, it's a little bit surprising that it took people so long to figure out that this was going to happen, because it was a matter of not if, but when. And you start to see sort of cracks under the surface in terms of certain economic data. And we did see labor starting to weaken a little bit long before we got the print today. So this is probably the typical herd mentality overreaction to the reality that perhaps when the Fed is finally going to start to lower, which obviously is looking out in September, if not sooner, if there's some major crisis, is too late. And so now the question is, what happens from here? Are we going to go into some major bad recession? Obviously, we're starting to see metals do well again, and the long bonds could be somewhat inflationary. So here's that stagflation that we've kind of been talking about, which is really, I think, the bottom line right now, and regardless of what the Fed does, although I don't think they're going to stay high for longer at this point.
You know, with that in mind, I mean, we're looking at, and this is based on some FactSet data here, Michelle, the blended earnings growth rate for the S&P 500 being 9.8%. So despite what's going on in the economy, companies still being able to show that they can exhibit earnings growth. Do you think that remains intact? And if so, for how long can they deliver that to the street, especially if we do see a Fed that's going to have to react to a worsening economic reading, at least from their gauges?
Well, I think maybe the needle has swung too far the other way right now because, yeah, you mentioned some good solid earnings. And I think we have to look at the consumer here as, of course, 70% of the GDP, which was good last month. And really, it's a matter of what are the consumers going to do at this point and what are they going to consume? We obviously can see that staples have done better than discretionary, and that might continue for a while. But I think what really with these earnings companies, it's going to be a matter of, does inflation pick up again? That's the key. A lot of these companies were able to maintain good earnings because inflation has come down, even though we've seen pockets here of prices going up depending on what area you're looking at. And that's going to be what's going forward. So if we're going into a stagflationary environment, there'll be companies that'll be able to get through it. Obviously, the big companies, you know, we could see Apple, for example, was up already today. And then there'll be other companies that will, we saw also a lot of negative earnings, and I think we'll start to see some of these companies that have not such great balance sheets not do so well, and others that have had terrible balance sheets maybe do better in a lower interest rate environment, again, if inflation doesn't really start to pick up.
Mish, when you take a look at the technicals, as you very much do, closely watching that, what kind of adjustments or moves should investors be keeping in mind, given what we could see in terms of the outperformance of some of those larger cap companies that are able to withstand what will be a volatile environment versus others who may be more subject to some of that risk?
Well, as far I can only tell you what we've been sort of preparing for, and in some ways I'm actually quite pleased to see this type of sell-off because there were pockets that I really were interested in that were getting a little too extended. So if we start with the big caps, for example, obviously Amazon went down, and I think that at some point you might be able to see a good buy here. I don't like buying a falling knife, but once we start to see some settling, I would certainly look at Amazon. I would look at Apple. But I want to move over actually to Tesla and EVs, because one of the things that I am pleased about here is that I didn't want to get into Tesla at 260 if you missed the initial move up. But at 205, 210, 215 in this sort of $10 area, probably not so bad. Rivian was another one, maybe the number two. Of course, the difference in the stock prices are enormous, but at $14 a share, it looks so much more attractive right now. It's got earnings coming up, so that's something to be aware of. And I think even in the consumer area, we had something like AbbVie go crazy, which is all a reflection on this diet drugs. And I think we'll start to see some good opportunities in what I'm calling the vanity trade. And then, of course, Bitcoin, we have to talk about that too. This could be another great buy opportunity as it's come off. And I'm looking at blockchain. So I think you have to just pick your areas carefully, assuming now that the economy has shifted to buy everything. And instead, let's look at what could survive a stagflation, possible recession, or maybe even a bigger inflation, which of course would be geopolitically involved, I think, at this point.
Calculated diversification is the word, or two words. Michelle Schneider, who is the marketgauge.com chief strategist. Michelle, thanks very much for taking the time here.
Thank you so much.